Hello. This video is to give some clarification about the differences between collateralized debt obligations, CDOs, and an, another type of derivative, which is called mortgage-backed securities. Sometimes people find it very difficult to distinguish between the two, and this video is to give a clarification as to what's the difference between these two. So let's first start with the kind of the highest level of derivative, which is called an asset-backed security. Asset-backed security. Now, as the name implies, an asset-backed security is a security that's basically backed by an asset. Think of it as collateral. For example, if you take out a loan and you offer a car as collateral, meaning if you can't pay back the loan, the lender gets your car. This may make the loan more attractive to the lender because there's added security, because if you default, they get something in return. And basically, the loan is an asset-backed security because it's backed by your car. Well, there could be many different types of asset-backed securities. They could be basically credit card debt could be an asset-backed security. Auto loans could be an asset-backed security. And of course, a mortgage-backed security is an asset-backed security because these mortgages, these securities are backed by the homes that they're derived from. So basically, it's just a class of asset-backed security. Now let's look at mortgage-backed securities. Previously, banks would loan out money, right? And it would generate, and these banks held these mortgages for the term of the loan, usually 30 years. 30 years was a typical duration for a loan like this. Now, what the downside of these loans was that they were very illiquid, meaning it took 30 years for the bank to receive the full benefit of these assets. Well, a interesting idea came about is what if these banks sold these loans before the term expired, before the 30 years, and they sold them to an investment bank. And the investment banks had this idea, what we could do is we could take these mortgages. So here's a mortgage, here's a here's a mortgage, there's a mortgage, and there's a mortgage. And what we'll do is we'll bundle them. And keep in mind, each one of these mortgages is generating a cash flow, the mortgage payment, right? And these could be very, very attractive to investors because they're generating a very, very stable amount of revenue, the mortgages. And if any one of them defaults, they're backed by homes which are going up in value. So if this one defaulted, the home that is linked to this mortgage could be sold and make the lender whole again. So that this is one of the reasons why these were very, very attractive to investors. Now, the way they sold these to investors is they took these mortgages, and the investment bank created a new type of company called a special purpose entity, sometimes called SPE. Now, this is kind of a shell company. Now, again, a shell company sounds very nefarious, but in this particular case, this company was created simply to hold these assets. So these assets were transferred over to the special purpose entity, and then the investment bank sold stock to investors for this special purpose entity. So you can see this stock, and these stock certificates basically entitled the holder to get a portion of the proceeds being generated by these contracts. And basically, This is called a mortgage-backed security. A mortgage-backed security is basically shares bought for a special purpose entity. Now, the problem, well, not, I wouldn't say a problem, but the issue here is how could you evaluate each one of these mortgages in terms of creditworthiness? Because once they're bundled into a mortgage-backed security, evaluating any one mortgage made it very difficult to evaluate the risk of the mortgage-backed security. Because these could not be rated, they were very limited in terms of who they could be sold to. Because if you think about some institutional investors like insurance corporations or pension funds, sovereign wealth funds, these types of investors, institutional investors, are legally obligated to buy investments that have a certain rating. Let's say, for example, CalPERS, that's the teachers investment fund in California. They are legally obligated to buy only AAA rated funds. Well, if these cannot be rated, they cannot be bought by these institutional investors. And these institutional investors are very big buyers. Then somebody came up with an idea to make these mortgage-backed securities more popular. What they did is they said, well, even though we can't individually evaluate every contract, what we could do is we could say, look, these contracts are generating revenue. And sure, one contract may go bad, but the chances of all three contracts going back are so small. So if this one contract goes bad, this contract is still generating revenue. What we'll do is we'll say that, come on. What we'll do is we'll create classes of mortgage-backed securities. Sometimes these classes are called tranches. A tranche is basically a French word for a class or category. And what we'll say is the first tranche is the senior tranche, and which means this tranche gets paid first. So again, remember, these securities are generating money. If this one goes bad, this guy gets paid first. Then if there's still money being generated, the second tranche, which is called the mezzanine, they're going to get paid. Now, if there is still money being generated from this special purpose entity, the third class will get paid, which is called the equity class. That's the lowest class. So what this did was it allowed rating agencies, Standard & Poor's, Moody's, Fitch, to say, look, this senior tranche, since it gets paid first, even though we can't evaluate these individual mortgages, we could kind of calculate the likelihood of so many going bad where it would not be able to pay out the senior class. And we would say that that is a very low risk. So we're going to give these a certain rating. And then we could then say, okay, what about the risk for the mezzanine? Then what about the risk for the equity? What this allowed is for the mortgage-backed security now to be rated. And these are what we call CDOs. A CDO is basically a mortgage-backed security that is separated into groups, tranches, that can be rated by credit agencies. This is what made the asset-backed market to go crazy in terms of size, because now these could be bought by institutional investors. And so since the rating agencies can rate them, so we'll give the rating agency gave, say, the senior tranche, which gets paid first, AAA, and let's say the S&P said, okay, mezzanine, you get triple B, and then equity, you get double C. And then what we're going to say is if you buy the senior tranche, or excuse me, if you buy the equity tranche, since it's more risky, it's only it's a triple C, it's a double C, you get a higher interest rate. Mezzanine, you're a little safer, so we're going to pay off a slightly lower interest rate, and of course the most secure or safe investment paid the lowest interest rate. And these became even safer because let's say you bought the equity tranche and it has a high risk. Well, what you can do is you could buy insurance, a credit default swap, CDSs, to insure your risky bet, which makes them even safer, at least perceived to be safer. And this is what allowed these collateralized debt obligations to increase in size. And as you could see that um, uh, the demand for mortgages to create mortgage-backed securities, then to create CDOs exploded so that investment banks needed more mortgages. And then commercial banks started to provide them more mortgages by getting creative, by creating subprime and Alt-A mortgages. Basically, these are mortgages to higher credit risk borrowers. And you could see that the subprime and Alt-A, this is the blue. The blue is Alt-A, and the subprime is the dark blue is subprime. And you can see as a percentage of overall mortgages uh, in 2006, 50% of all mortgages were either subprime or Alt-A, which means higher credit risk borrowers were generating the mortgages that were feeding the collateralized debt obligation market. So, because riskier loans were being made to create CDOs, the need for credit default swaps grew, and maybe some people felt that these were more CDOs that were going to kind of go bad. Maybe these credit default swaps would pay off. So you could see as time went by, look at the growth in the insurance for these CDOs. Now, keep in mind, this axis is trillions of dollars. So you can see in late 2004, it was about $7 trillion, right? But 2005 rolls around, it's growing, and you could see by the end of 2005, it's doubled from this amount to this amount. But look at 2006, it grows even higher. And then look what 2007, the year before the financial crisis, they explode. $60 trillion worth of credit default swaps were issued, which means if the CDO market goes bust, these pay off. But the big question is, did the financial institutions who issued the credit default swaps, did they have enough capital to pay them off if these go bust? And the question was no, they didn't. So this insurance was kind of illusionary because the agencies issuing the credit default swaps didn't have enough money to back them up once the CDOs started to go bad. So hopefully this helps you understand the difference between a mortgage-backed security and a CDO.